This video shows you what happens with our modeling system if a self-reported below average credit score is reported by the applicant. We've got a 70-year-old homeowner, no birthday anytime soon, with a $750,000 property in Utah, below average credit, $350 a month car payment, $125 is the minimum credit card payments, living in a single family home, husband and wife, no HOA community, 2,000 square foot home, and that's all the real estate they own. Income is $5,700 a month. Checking and savings, they got 15 grand and 125,000 in an IRA. That's all the real estate they own. They have no mortgage, they're free and clear. Their annual property taxes are $4,500, and the annual hazard insurance is $1,500, so that's $6,000 a year. That's what we will be paying on their behalf, $6,000 a year going forward. Because what we do when they self-report below average credit is we create a reserve account. We're not going to let them have all the money they would normally access in the line of credit. We're going to hold some back and use that money held back to pay that $6,000 a year for a number of years. How long? We estimate it to be for their actuarial life, which for a 70-year-old using the Social Security database or actuarial table is 15 years. So now you're going to look at this, and it's going to look similar to what you saw before for these types of free and clear borrowers. Beautiful line of credit growing, opportunity to compare that $221,000 initial line of credit to how much they'd get over 10 years in an annuity style payment and over 30 years in a lifetime payment. The static example changes though. Now we've got this slice populated. We're going to hold back $70,000 and put it into this property and insurance reserve. The rest of this is just hypothetical, maybe immediate cash of 11, maybe allocate something to the monthly payment and leave the rest in the line of credit. We're going to build your reverse mortgage now. This I'm sure looks familiar with what you've seen before. We're not going to really change things on the interest rate scenario for this discussion or the property value appreciation rate. Sure, we'll give them 10 grand up front so we can pay off the car loan. So they can pay off the car loan, And that shows up right here. And once again, you see that property tax and insurance reserve, and everything else is in the line of credit. So now if you think about this, let's jump to cash flow. We're showing a $100,000 positive cash flow benefit over 15 years. $10,000 of that is what we gave them at closing to pay off their car loan. The other $90,000 is $6,000 a year for 15 years. That's where we're getting that cash flow. We're paying the taxes and insurance for them. They don't have to. That's a cash flow benefit. Because we're paying that $100,000, that's why we have a mortgage balance of $238 over 15 years. It's starting off small because they don't have any initial mortgage that we're paying off. We're just paying financed fees. Then we're paying them for 15 years, paying the tax people and the insurance company for 15 years. That's being added on to the loan balance. And the interest and the FHA insurance accrues over those years. Equity will go up from $750 to $930, so they'll gain $180,000 of equity without having to pay anything on this mortgage and appreciate a $10,000 cash flow benefit, net positive impact of $280. Plus, they'll have over $500,000 available to them in that line of credit. Once you've gone through these, click on the summary. This is the same sort of information you've seen before about the features and benefits and flexibility that you have with a reverse mortgage, the upfront fees to set this thing up. What's different now is now we're going to see property tax and insurance payments of $6,000. That's a positive cash flow for them because they don't have to make those payments. And here's where you see that cumulative adding up over the years. And over 15 years, it hits that $100,000 mark at age 85. You also see the $10,000 they get at closing. That's also a positive cash flow impact for them. The amortization schedule is what we use to estimate their future equity and such. These are the payments that go to the tax and insurance people. So that's going to increase the loan balance. plus the interest on the FHA insurance, so that's how you see that loan balance going up every year. They still have a very significant line of credit they can draw on. That's growing over time. And they have a healthy amount of equity in the future. Now you see these payments going for many years, more than the 15 of their actuarial life. And that's just a function of the way the thing is set up with current interest rates, this reserve account. There is an inflation factor built in, but we don't really know how long that $70,000 is going to last. It's going to last long enough, maybe, maybe not. It really depends on what insurance charges will be in the future. We've seen a pretty rapid increase over the last few years in many parts of the country, maybe most parts of the country. Property taxes might also go up. So that's going to be the primary determining factor, is the inflation factor on property taxes and insurance. That will determine how long this reserve account will really last. Clearly, it's not an economic imposition on them. If we're withholding 70 and we're expecting to pay at least 90, that's not a bad deal. And once we run out of money out of this account, they'll be notified well in advance so that they will know when it's time to start paying those property taxes and insurance fees on their own. And if they're having a little cash flow struggle at the time, good news, you got a lot of money in your line of credit ready to use. And you don't have to apply for anything. There's no credit check, no income check, no appraisal. The money's just right there waiting for you. So just want to let you know that's how the the system works when somebody reports below average credit. And this will be true if they have a current mortgage balance as well. We'll just type in $100,000 and take a really quick peek at that one. So they got a payment of $950, 26 years left, and yes, there are impounds accounts on that. We click here. We're going to see a slightly different approach right now, but you will see these property tax and insurance payments. That's populated now, and it wasn't before because we're making those payments on their behalf. The rest of the process is going to be pretty much the same. So don't worry if somebody self-reports below average credit, or after you interview them on the phone, you think it's appropriate to do that self-reporting of below average credit, so they won't be surprised when they see in a proposal or an application this reserve account.